Okay, so today we will be presenting about the stock market, and so to begin, I just asked you guys, what comes to your mind when you think of the stock market? What would you say the stock market is? Go ahead. Investing, okay. Anyone else?
No.
Okay, well, the stock market is a collection of markets and exchanges in which people trade and issue equities, bonds, and securities. And the stock market is a big aspect of a free market economy in which companies are granted access to capital in return for slices of ownership in their company.
Right, so why is it important? First of all, the most obvious reason why it is important is companies get access to money. So if any company who's listed in the stock market wants to get access to new money, they can just give out new stocks and they get fresh money without the need of going to a bank and getting a loan. So this is really important. On the other side, in an economy, you've got a lot of people who have money that might be private people who just save money, or financial institutions such as insurance companies. They got a lot of money and they needed to invest it somewhere. And the stock market is the place where borrowers meet lenders. So as a result, that means investment increases. And as most of you will know, investments are very crucial to economy. So investment boosts things like employment, things like economic growth, trade, and all that stuff. But it's not only companies that borrow money on financial markets, also governments. So, for example, all of you will probably know that the US has a huge level of debt, and the financial markets are the markets where they get access to new money and can borrow money to satisfy that need for fresh money. And last but not least, stock markets are an important indicator of economic performance. So, for example, the Dow Jones is the most important stock index in the US, and it's seen as an indicator worldwide. So if the Dow Jones is really high, that's seen as a sign that the US are performing really well economically.
So, getting started with the stock market, something to decide before you get started is what your risk level is. And at our age, most people would say it's okay to be a little more risky, because if you do lose everything, you have time to get it back. Versus someone who is about to retire, they don't want to be they want to be a little more risk adverse, because if they lose it all, it's kind of a problem. So you really have three options. If you want no risk, you can do simulations online. There's some great websites that you can practice trading fake stuff, and it's not actually real money. Two, if you're pretty risk adverse but you still want to get involved, you can do index funds, which is basically kind of putting a little bit of money as the market as a whole. It's definitely a little safer, and if you're a little more like you want to take a little more risk, then I would go with mutual funds. But whatever you do, the really important thing is make sure you have risk capital, which is basically a certain amount of money that you can put away. If you lose 100% of it, you're okay. Like, it's not going to affect your day-to-day lives, not going to affect your food money. So that's one really important thing to realize before you get started in the stock market.
And lastly, I'll go over just certain general guidelines for investing for the long term. So long-term investing, it's different for different people. So some people might consider it 3 to 5 years, or like 10 to 15 years. So what you want to take into account is when you need the money back. So if you want to set up a portfolio where you want the money back in, let's say, 5 years, you're going to want a higher percentage of bonds and like fixed income, because it's going to be more, it's going to like hedge your bets against like market volatility. But if you want to invest over like an indefinite amount of time, and you want to see growth in your portfolio, then you want to take then you want to manage a portfolio that's that has more money in equities, so you have a greater chance of growth over an amount of time. Additionally, when considering opening accounts, it's important to look at commission fees that brokers take, and minimum values that you can put into an account. There are definitely a lot of easy online electronic traders, such as like Vanguard and Fidelity and E-Trade. I know I invest a small amount of money in like an ETF, and it's just like a good way to understand like the market and kind of get like your toes into the water. And lastly, it's important to diversify your portfolio to hedge against any type of like volatility. So you want to make sure that you are not putting all your money within a certain sector, and that you spread out your wealth. And that doesn't necessarily just mean put your wealth in equities. It's important to look into like bonds and other securities.
Thank you.